All right, welcome to Peace of Mind Radio podcast. I am Brian Ramsey. That is Chris Vaughn. That is...
I am Eric Douglas.
I think I always introduce you guys, but I thought I'd throw you a little curveball this afternoon. Anyway, it is Friday.
You forgot our names. So.
No, it's Friday afternoon. It's kind of gloomy.
That wouldn't surprise me either.
Yeah. No, it's kind of gloomy Friday, so I figured I'd try to perk things up. So anyway, all right. So today's a pretty relative topic. When we sat down and said, "Hey, what's a kind of a topic of today?" Just so happens that these crazy stocks that really have no value are now back in the headlines, which are AMC, GameStop, Bed Bath & Beyond, etc. Now, full disclosure, this is in no way a recommendation to buy or sell or hold or trade or whatever any of these positions. That is not what we're talking about. So do not take this as advice for investing at all. Yeah. All we're doing is talking about a relative topic and essentially why we think these things are happening, right? I mean, some of it's based off what we know is happening, and then we're going to also put in our opinion on why we think these stocks are being traded the way they're traded, right? Yep. So with that being said, again, full disclosure, this is not any recommendation to buy a stock or mutual fund or anything for that matter. Nothing like that.
Especially these stocks.
Yeah,
exactly.
Yeah, and go look at the chart on these things, and you'll know why we say that, especially about these positions. But anyway, all right. So, who wants to start off the conversation on? Well, first of all, just somebody give an overview of why we thought this was a relative important topic to talk about.
Well, I'll start. Basically, the reason we thought this might be a relevant topic to talk about was because, when clients come into the office, prospects come into the office to ask us questions, inevitably we get a lot of questions about things that are occurring in the news, or at least that are headlined in the news, I should probably say.
Yep.
And what's been very popular over the last couple months and is getting more popularity because we're starting to see it again, are some of these quote-unquote meme stocks where they're gaining a following on the internet, specifically GameStop, AMC, Bed Bath & Beyond is gaining a lot of steam. There's a couple others as well. You've even seen it with silver a little bit as well. That was a topic at one point. But you're seeing them get a lot of publicity, and there's been a ton of volatility. In the GameStop specifically, there was, it quote-unquote shot to the moon, right, according to what was happening on the internet. And you're seeing that now with AMC, and we just wanted to talk a little bit about what is actually occurring because we get questions about what's going on with those stocks specifically because that's what's in the news. And so we wanted to share what's going on, why we think maybe it's happening, and certainly not making any recommendations on this podcast by any means. But
well, I mean, something that I'll throw in right there just to kind of get it started on why this is happening. We recorded a podcast, I don't know, a few weeks ago. And Eric, you can tell us if it's out and available to everybody yet, about how news headlines have a huge impact on the way that people see the markets. And you just have to keep in mind that the news is trying to get people to view it or to read it or whatever that source of media is. So they tend to be very sensational. And that's one of the things that's driving these these meme stocks.
Well, it drives a lot of fear of missing out, FOMO, right?
Exactly.
It drives a ton of that, too, because you see in the headlines where GameStop is shooting up 30-40% in a day. Right. Well, the next day you don't tune in and see, that it's dropping 30-40% after it shot up the day before. So, but we get questions about it, and we field a lot of questions, and we want to make sure that we're doing our part to educate our viewers and listeners as much as we possibly can.
Yeah, so let's start off with GameStop. That's really the one that started all this, right?
Yeah, it was.
And so there was lots of, pontificating on why it was happening, what was the underlying cause. And I think they pretty much came to the conclusion that it started with some tweets, or not tweets. I don't know if you tweet on Reddit, but I don't know if you're.
No,
that's
it's
really,
a
okay. You post.
Platform.
All right. You post.
That's a question for Eric.
I don't. But full disclosure, as you clearly know, I don't do Reddit.
Right.
But it started in social media. Let's put it that way.
Yeah.
Right. And so what happens is on any stock position that's traded, as you guys know, there are ways to go out to see what options contracts are written on a security. Okay. Now, an option contract is basically I'm not going to get into it, but it's basically you're saying I'm willing to buy that particular stock at a certain price at some point in the future.
Right.
Right. And you can either, when you do that, there's two sides of the trade. There's a buy and a sell essentially.
Yep.
And you can either take and say, I think the stock's going to go higher, or you can say, I think the stock is going to go lower. And you can take both sides of the trade, or you can take either side of the trade. You can take both sides of the trade too. But
in every transaction, there's a buyer and there's a seller.
That's right.
Correct.
Yeah, so you can go and find, and it's more and more relevant today than it was, say, 15 years ago or 20 years ago when I got started in the business. You had to call the desk and it was very difficult to find out how many contracts are written on a security. But now it's pretty available, right? You can go to your E-Trade account and look at the options contracts and see what are written. So what happened was, in general, they saw that there were a lot of put contracts, meaning there were bets that the price of GameStop was going to be lower in the future. They saw that there was all this volume written for put because all these institutional groups that put all these contracts in there said, we think this price of the stock can go lower.
Right.
So a couple guys were like, hey, I see they're loading up on put options on this position, so we're going to go out to our social media platforms and we're going to be influencers and we're going to have everybody buy the price of the stock. Now, why is that important to the guy that basically says he thinks it's going to go lower and you're trying to push the stock higher? Anybody want to tackle that one?
Go for it.
Well, so whenever you short a stock, you're technically not buying the stock at that point. You are buying the right to buy the stock at a later time.
That's
so
right.
essentially what you're doing is you're borrowing shares of that stock. You're immediately selling those shares. In the contract, you're saying that you're going to buy back at a certain price point at a future date, with the assumption being that you're going to sell. You're going to buy at a lower price than what you sold,
and then return
the spread,
it to who you borrowed it from.
Exactly, and the spread is what you make on that stock. That's how short sellers make money.
Yeah.
So essentially, what was happening was you were seeing these hedge funds, large institutional buyers that were, to your point, there was a lot of short interest in that specific stock and some other ones as well. So they were betting on the price of that stock to go down. Well, if the price of that stock rises, and if you see large quantities of interest, it coming in to buy the stock, that's going to drive the price of the stock back up.
Yep.
So what that forces the short sellers to do is inevitably they have to end up buying back that stock. They're forced to buy that stock because options contracts have a deadline.
Yep.
So if it's a 3-month options contract, for example, in 3 months you have to buy back that stock at whatever the price of that stock is at that point. So you saw people in the market that were trying to drive the price of the stock back up because they knew there was so much short interest in these options contracts were set to expire that they were going to be forced to buy back that stock at a certain price, which was even going to drive the price of that stock up even further.
And it gains momentum as it goes up.
Exactly.
Yeah,
That's the reason it skyrocketed so fast.
Yeah, so think of what this would be a good example. So last week in our podcast, we talked about cars, and we talked about buying a car.
Yeah.
Okay. So it's kind of the same thing, and I hope I get this illustration right. But if I bought a car, right, and I paid X amount of dollars for it. Let's say it's $50,000. Okay. I go out and something happens to the car. Now the car's worth $40,000, but I owe $50,000 on the car. So even though I sold it for $40,000, I still have to pay the other $10,000, and that's essentially what short selling is, right? When the price of the stock, if you're saying it's a $30 stock and you're saying, I bet it's going to go to 10, and it goes to 10, you make $20 a share. If it goes to 30, now you owe $10 a share. Yeah. That's kind of the point, right? So what these guys did on this social media platform, they're like, hey, these are the big institutional, the concept was that the short sellers were these big institutional hedge funds that basically make millions and millions and millions of dollars every month off the backs of individual investors because they're short and they'll put pressure on a stock because they load up options contracts either higher or lower, which drives the share price. They get out of it and make $1 a share, but they got millions of shares. They make millions of dollars per trade. So these guys are like, hey, let's give it back to the institutional guys. So they got on their platforms and said, hey, everybody, there's a bunch of, these institutional guys are now shorting GameStop. We know it, regardless of whether the company has any value at all, let's put it to the institutional guys, and so they started driving up the price, right? So they started driving up the price. Well, y'all can remember it was like a $20 stock, and it went to $400 and some dollars a share
in days.
Oh yeah, within a couple of days.
Yeah, time,
so it just rocketed up. I mean, I remember seeing it was up 1,000% or so. I mean,
crazy
it was
numbers.
Oh, it was crazy numbers.
And plus, it happened in the middle of. I mean, you also have to remember, taking a step back even further. This all happened kind of in the COVID era when everyone was at home at that point a year ago today,
which was one of the driving forces, no doubt.
And so more people were going online. There was an increased interest in buying and selling stocks. Other personalities, media personalities were doing it, and so it became a much bigger thing. So there was an increased interest on it. And to your point earlier, when you talk about it used to be really hard to do this. You had new apps like Robinhood that it made it much easier to be able to make these types of trades and buy these types of contracts. So,
well, look, at the end of the day, if you're an individual, what they planned on was the average person that was a follower could jump onto apps like Robinhood or whatever and buy 2 or 3 shares of this thing per person. Well, you get hundreds of thousands of people buying 2 shares. It's a lot of volume, right? It's a lot of volume, which drives up the price.
Yep.
And it basically sunk a couple of these institutional guys. I mean, literally one of them, they had to go borrow, I heard, like $2.8 billion from another hedge fund just to cover the short sale.
Yikes.
The short position. So anyway, that's kind of what started this whole thing, right? And we've seen others. I think we were talking about silver was an issue at one point.
They were trying to drive the price up of silver, AMC, and the reason it's back in is because AMC, they're doing that again with AMC.
They're doing it again with AMC,
that, at one point that stock was down like less than $2.
Yeah.
Today it touched 30. I don't know if it's still up there, but so we're seeing it happen again, which is why this is timely again.
Right.
I know Bed Bath & Beyond is another one. They're trying to. There's a lot of short interest in that, so they're trying to drive that one up again.
Right.
So these have become known as the meme stocks, and there's some other ones out there, but those are the primary ones.
Yeah. So the reason we bring this up is, one, because it's a relevant topic, and we do have clients that come in here and say, "Hey, what's the story going? What's going on with GameStop? I watch CNBC or Yahoo News, and it's all over. So I want to kind of what's going on." So we've explained to them a little bit how option trading work, and we don't get into too much detail, but it is relevant. And I think there's 2 important lessons to learn out of that. One, we talked about 2 or 3 weeks ago, which is sort of staying in your lane, right, and not trying to get outside your lane and invest in things you don't know about, but not letting the headlines of the markets or whatever show you're watching or whatever news that you're consuming, where you can't let that influence how you invest in money. Would you guys agree?
Yes. Keep your emotions out of it.
Yeah, that's why. So stay in your lane.
Yeah, and you would put it this way. I mean, as long as you are reaching your goals and you're staying on track with your financial plan, everything else is noise.
Right.
And that hasn't changed. That does not change regardless of what's happening in the headlines or on the TV. Financial media every day.
Yeah. So that's one thing. Just let the noise go and be noise. Don't worry about the whole fear of missing out thing. That's huge. I mean, we see that all the time. Some topic comes up about a position or gold or whatever it is. Clients start calling back in. Hey, do I need to do this? No, you don't. Just we're going to study our course. But so watch where you get your information.
Yep.
Don't get caught up in the headlines and all that good stuff, right?
Don't get caught up in the sensationalism of the headlines. That's where your emotions can just start driving your decisions.
Well, the other thing, too, is by the time you're seeing it in the news, it's already happened.
True.
You've already missed the boat. Yeah. And so the danger lies in going to try to find the next headline, the next stock that's going to make all the headlines, that's going to rocket up 50% in a day. That's where you run into a lot of trouble, because ultimately it's not necessarily about AMC or GameStop. It's about other people trying to find the next AMC and GameStop. When you look at the number of stocks that are out there, and especially when you start looking at plain and penny stocks and things like that, that gets dangerous. That's not investing. That's trading.
Correct.
Yeah. So the other sort of lesson to be learned in all that I think is important is, if you have an interest in buying an individual stock position, one of the best piece of advice I ever received in this business was right when I first started the business. I actually thought I wanted to be kind of that stock jockey, right? I thought it'd be cool to go and buy shares of stocks and all that. And I had this gentleman, I worked at one of the big wirehouses when I first got started, And I asked him about it, and he was like, "Look, don't get caught up in reading charts, and and this is back when they posted everything in the newspaper every day, and you could get back and what I'm talking about." And he's like, "Look, if you're going to invest in a company, invest in companies that you either eat their product, wear their product, use their product, or have an interest in their product. Do something that has an interest." So as an example, this has been years and years and years ago. I bought one of the very first generation iPhones. Okay. I bought it. It worked great for like 6 months, and then I had an issue with it. And they said, you go to the Apple store, which was in Oxmoor Mall, I think. I go walking in there, and first off, it was like a Tuesday morning at like 11. I'm thinking, there's nobody going to be there.
Packed.
Slam packed. And when I finally got somebody, he was like, I can take your name and have, you can come back on Tuesday. I'm like, what in the world are you talking about? I have to come back? I come in here, filter through all these people, and I have to make an appointment? I was like, all right, Apple's got something going on. So I did my due diligence. I read about the company. I was like, hey, I'm using their product. So I invested a little money in it. And so that's paid off, right? I mean, obviously, anybody.
Once again, not a recommendation to buy.
Yeah, no, it's not a recommendation. I'm just saying when you do it, either have some interest in the product, you wear the product, whatever the case is, but do your due diligence. And that's for any investment.
That's straight out of Warren Buffett. If you read the concepts that he's talked about, one of them is you always invest in companies that you personally understand the product, the way they go about doing business. So, for example, if you never, ever, ever drink anything except water, kind of a silly example, why would you buy Coca-Cola? You don't understand the product. Right? So, that's exactly what you were talking about there. You have to understand what they do or you're just guessing. And that goes back to buying the meme stocks. Do you really understand what these companies do? Well, here's a good example, and I'm going to bring full circle from what we did last week. Well, it was actually a couple hours ago, but actually in a couple of weeks, because the show we just did last week is not going to air for several weeks. Right. This one's going to air before that. But anyway, we did a show on buying a car. Yes. Okay. Which we Once upon a time.
Yep. But the purpose is, which is no different than investing in a security or any investment. It's the same thing in investing in like a vehicle. You're not going to just walk out to any random car lot and just pick one that you saw on TV that was, hey, this particular car, and just pick it. Never test driving it, never doing any kind of research, never doing getting the Carfax. No one would ever do that.
Great example.
Right? Yeah. So you're going to go out and do your research. You're going to get the Carfax. You're going to go test drive it around. You're going to move all the chairs and make sure everything works. And then if the
price is right.
Yeah, and then if you look at it and say, okay, it's fairly priced, like you can go to basically any car guru or auto trader, it's going to say whether it's good price, fair price, whatever. Yep. So you've done your research and said, yep, it's a fair price. Then you've done all your research in order to buy that car. It's no different when it comes to security. Yep. Any security, mutual fund, exchange traded fund, stock, makes no difference. You have to do your due diligence, and you have to make sure that it's not overpriced, it's fairly priced, and it has to be, what you're interested in investing in. Right? There's no difference in that whatsoever. So anyway, that's kind of the point behind it.
You shouldn't spend more time reading random Amazon reviews for something you're about to buy there than you would making a stock purchase.
That's true.
Wow.
Well, I mean,
the sad thing is, there's people that do that.
I do it. Right.
Okay.
Well, I'm not talking about buying stocks. I'm talking about reading reviews on Amazon and doing due diligence on even just like a $20 purchase on Amazon. Right. Just for something pretty simple. So you should be doing more due diligence
on the stock purchase, right? Okay.
Than something random that you'd be buying online.
Yeah, and so I think that's the point of today is, and why we hadn't spent a ton of time on it, why we've really not done this in the past, is because we tried to keep clients sort of out of the noise and not pay attention to the noise, and just sort of steady your course. Right? We build great portfolios. We're not taking wild chances on GameStop or AMC or anything like that. There's no reason to do any of that. And for the most part, as long as you have your plan in place, there's no reason to go and do that unless you just want, kind of play around. But that's a totally different topic of conversation. So anyway, point today was, yes, there's noise around these positions. Don't get caught up in the whole fear of missing out. Don't get caught up in buying or investing in something that you know nothing about. Just steady Eddie, invest in nice core holdings and just make sure that you're saving enough so that you can have enough so that you can live your life the way you want to. That's kind of the point behind it.
There you go.
Right?
Absolutely.
All right, very good. Well, listen, that's it for another week. And by the way, if you want to call us and talk to us about AMC or GameStop or anything else, it's not a recommendation to buy. I cannot emphasize that enough. But if you want to just ask, in theory, why is this happening, we'd be happy to talk to you. We also have another podcast, so make sure you check out every week for this podcast, Peace of Mind Radio podcast. We also have another one that is Connecting the Commonwealth, where we do nothing but talk to other business owners about products and solutions for small businesses around here. It's kind of a cool one. It's one of my favorite ones that we do. And then we have a third one called Burgers and Bourbon, which we were going to try to do today. We're not going to be able to do today, so I'm kind of a little bummed. But anyway,
I'm just kind of hoping that nobody can hear my stomach growling in my mind right now, because I was thinking about that one.
I know. We did actually pick out a pretty good burger place. Well, the burger place is kind of cool. I don't know if the burgers are any good because we've never been there. We'll find out next time. But anyway, all those come out on a weekly basis, so we like to put a lot of content out. And I'll let Eric close us out because I can never remember what he says.
I'm sure the producer's going to put this up on the screen, but when they're trying to call us, what would that number be?
Well, you do it.
I'll do it. Okay. So it's 502-200-5210, or you can email us at info@fwppartners.com.
All right, Eric, sign us off.
Yep. So if you're watching this, we appreciate you giving us a like, giving us a subscribe on YouTube. If you can leave a rating and a review on Apple Podcasts, that'd be greatly appreciated as well. Thanks for tuning in.
Have a good week.
The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.